Everyone wants to be rich. Everyone wants to invest like Warren Buffett or Ray Dalio and retire early on a yacht. But here's the brutal truth. Most investors fail. According to research, over 80% of retail investors fail to beat the market, and many end up losing their entire investment. They don't just underperform, they lose money. And the worst part? They don't even know why. Is it just bad luck? A lack of knowledge? Or is the system designed to make them fail? Today, we're breaking down the biggest reasons why most investors fail, and more importantly, how you can be in the top 1% that wins consistently. And make sure you stick around till the end, because I'll reveal the single biggest mistake even experienced investors make, and how you can avoid it. Let's get real for a second. The biggest reason investors fail? Their own psychology. It's not the market, it's not bad luck, it's them. Take this. The S&P 500 has historically returned about 10% per year. But the average investor? They make around 3 to 4%. Why? Emotions. Let me ask you a question. Do you think the wealthiest investors get their advice from CNBC? From YouTube? From Twitter? No. The top 1% don't follow the news. They create the news. Most investors buy high because they get greedy and sell low because they get scared. This is called FOMO, fear of missing out. And Wall Street, they love this. They need you to be emotional. They buy when everyone else is scared and sell when everyone is greedy. That's how they make money. But here's what they don't realize. By the time everyone is talking about an investment, it's probably too late. Think about the dot-com bubble of the late 90s. Investors saw tech stocks skyrocketing and rushed to buy at peak prices. When the bubble burst, they panicked and sold at massive losses. The patient ones, however, those who invested in companies with real value, came out stronger in the long run. Here's something crazy. Psychologists call it loss aversion. We feel the pain of losing $100 twice as much as the joy of gaining $100. That's why investors hold on to losing stocks for too long, hoping they'll recover instead of cutting their losses and moving on. Here's another psychological trap. Overconfidence. People believe they're better investors than they actually are. They think they can time the market, but studies show that most active traders underperform the market. The best investors? They admit they don't know everything. They stay humble and stick to proven strategies. In 2021, millions of retail investors thought they could beat Wall Street with meme stocks like GameStop and AMC. Some made millions, but most lost money when the hype faded. The top 1% of investors? They remove emotion. They use data, discipline, and patience. They follow a strategy, no matter what the headlines say. The best way to do this? Automate your investing. Set up a dollar-cost averaging strategy where you invest the same amount every month, no matter what. This removes emotion and keeps you in the game for the long run. Want to protect yourself from fear and greed? Set rules before you invest. Decide in advance. When will I take profits? When will I cut losses? If you make these decisions when you're calm, you'll avoid panic when things go wrong. The best investors set stop-loss orders at 10 to 20% below their buy price, so they never get trapped in a stock that crashes. If you want to be in the top 1%, you need to think in decades, not days. Stop obsessing over short-term movements. Look at the big picture. The market rewards patience, not panic. If you had invested $1,000 in Apple stock 20 years ago, today you'd have more than $227,000 at an annualized return of 31.2%. Including dividends reinvested, you'd be sitting on nearly $270,000. Another major reason investors fail? Impatience. People want instant returns. They see a stock go up 10% and think, that's it, I'm cashing out. Meanwhile, the top 1%, they hold for decades. They let compounding do the heavy lifting. If you'd invested $1,000 in Tesla shares at the beginning of 2015, you'd have a stake worth $27,615 a decade later. That's an average annual gain of around 39%. But most people sell after making a small profit instead of letting their investments grow. If you want to be in the top 1%, stop thinking in days or months. Start thinking in decades. Invest in high-quality companies or index funds and forget about them. Check your portfolio less often and focus on long-term goals instead of daily price movements. Be honest. How many times have you bought a stock because you saw someone hyping it up on Reddit or Twitter? In the 1630s, the tulip mania is one of the earliest examples of market hype, where Dutch investors speculated on tulip bulbs, believing their prices would rise forever. People mortgaged homes to buy tulips, but when the bubble burst, prices collapsed overnight, leaving many bankrupt. Just because something is trending doesn't mean it has real value. If an investment is driven purely by hype, it's a bubble waiting to pop. Hot tips are like lottery tickets. Sometimes you win, but most of the time, you get burned. And the top 1%? They're not gambling on hype. They're buying businesses, not just stocks. They study fundamentals. They read earnings reports. They actually know what they're investing in. In 2021, the American video game retailer GameStop short squeeze created overnight millionaires, but most people who jumped in late lost big when the price crashed. The ones who did their research knew the risks and had an exit plan. Next time you see a hot tip, ask yourself, would I still buy this if nobody was talking about it? If the answer is no, walk away. Instead, build a habit of researching investments properly. Read financial statements, study industry trends, and invest based on real value, not hype. Many investors think they need to be financial wizards to succeed. But here's a secret. The top 1%? They keep it simple. Most people would be better off just buying the S&P 500, Vanguard index funds, or ETFs and chilling. Instead, they try to time the market, pick obscure stocks, and trade constantly. And what happens? They lose to the market. Studies show that 80% of day traders lose money. The simple strategy of consistently investing in an index fund outperforms most actively managed funds. If you want long-term success, stop overcomplicating it. Stick to simple, proven strategies like low-cost index funds, dividend stocks, and dollar-cost averaging. The fewer decisions you have to make, the better your results. Here's where most investors really fail. Risk management. They put way too much money into a single stock, and when it crashes, they're wiped out. The top 1% never bet the farm on one investment. They diversify, they use stop losses, they hedge against downturns. They understand that preserving capital is just as important as growing it. One of the most infamous cases of ignoring risk management is the collapse of Barings Bank in 1995. Founded in 1762, Barings was one of England's oldest merchant banks, and at one point, even Queen Elizabeth II had an account with it. A single rogue trader, Nick Leeson, made unauthorized speculative bets on the Japanese stock market. Instead of managing risk, he doubled down on losing trades, hoping for a recovery. His hidden losses ballooned to $1.3 billion, wiping out the 233-year-old bank in a matter of days. In 2008, the global financial crisis was largely caused by banks ignoring risk when dealing with mortgage-backed securities. Institutions like Lehman Brothers took on extreme leverage. Betting on the housing market's continued rise. When the market crashed, they faced catastrophic losses, leading to Lehman's bankruptcy and triggering a worldwide recession. The best investors focus on risk first, profits second. Before you make any investment, ask yourself, how much can I afford to lose? If the answer is not much, then you're betting too big. Diversify your portfolio and always have an exit strategy. Investing isn't about luck, it's about discipline. Apply these lessons and you'll be way ahead of 99% of people. Now go out there and make smart moves.